Hi, this is Brian Daly with REIG Renovations with our February installment of the REIG's monthly market update. And this update is based on January 2016 statistics that we got from Sandecor and InfoSpark. So if you've listened to our last few updates, I've been predicting an uptick in prices at the beginning of this year, and that definitely got started quickly in January. We saw the median price of San Diego County homes, both detached and attached combined. We saw that jump up to $470,000. That is up from $462,500 in December, which represents a 1.6% increase in prices just from month to month, and 8% increase over January of last year. I mentioned in my last couple updates that I expect to threaten a double-digit appreciation just within the first 6 to 7 months, and we definitely got started on that in January. Inventory is still super tight. We are down at 2 months, and that's even with December, which is kind of expected, but that's still at the lowest level that we've seen since in this market cycle. Back in 2013, I think we were at like 2.3 months of inventory. Now we're at 2, and I really feel like that's going to fall with the amount of demand that I'm seeing, which is tied directly to interest rates. And our good friend Paul Johnson at Caliber Home Loans always helps me with his data on mortgage interest rates, and he is expecting mortgage rates to take a run at all-time low levels. And with such limited supply and such low interest rates, I'm expecting demand to really pick up. So if you're trying to sell your house, now is the time. There's lots of buyers out there, and they want to lock in these rates. So sell your home. We need more sellers. We need a more healthy market. So basically, in Paul's comments, the Fed raising the Fed rate actually helps mortgage bonds, because one of the biggest killers of mortgage rates is inflation. Once inflation starts going up, mortgage rates start going up, because there's no investors that want to invest in a long-term bond like a mortgage bond at a 3% rate if inflation is at 4%. They're basically losing money. So the Fed being on top of raising rates is actually helping the bond market. I don't expect the Fed to raise rates again, because we haven't seen any inflationary pressures, but with the global economy a mess and United States economy doing pretty well, money is pouring in to bonds, and Paul, again, he expects that interest rates are going to go down to all-time low levels. So that, coupled with low inventory, we're seeing buyers on our listings. We're getting offers quickly, and multiple offer situations often. We haven't got that frantic feeling yet from buyers, which is good. We don't when 20 buyers are bidding on one property, it's not a healthy market. So we're not there yet, but I wouldn't be surprised unless we start seeing more people selling their houses. I'm still expecting to hit 10% appreciation or close to it by June or July. So that's what I'm seeing right now, and we'll be back in several weeks with our update in March with February statistics. And please join us then. Thanks.